Welcome to A Canadian Investing in the U.S., a podcast and YouTube channel focused on Canadians buying real estate, with host Glenn Sutherland.
Welcome to another episode of A Canadian Investing in the U.S. This week, my guest is Caleb Bryant. Caleb, you know what? Tell us a little bit about yourself.
Hey, Glenn, appreciate you having me on the show. I'm Caleb Bryant. I live down in Huntsville, Alabama area, and I invest here in North Alabama. I buy apartment buildings mostly, and it's been going pretty well here. So thanks for having me on the show.
Awesome. So I know that you're mostly buying in Birmingham, even though you live close to Huntsville. Why Birmingham and not Huntsville? What's the attraction to Birmingham?
There's a very great reason. It's because I keep finding deals there.
Okay.
So I have a team, and they are actually from Birmingham. So their relationships go back a long time. We haven't built those same, like the depth of relationships here in Huntsville, and we are working on that. But the deals that we found haven't truly been deals, if you know what I mean, in the multifamily space at least. I've bought a lot of single families here in Huntsville with a partner here, but all my multifamily has been either Birmingham or I've invested in it passively in other people's deals.
Awesome. What are you looking at? Like, what are the kind of numbers you're looking at for your deals in Birmingham?
I'll start by saying we follow a slightly different model than most people I know doing multifamily. Most people doing multifamily or larger multifamily are syndicating, and we've been doing joint venture deals. So we'll bring in one or two additional partners that bring maybe 50, 60, 70% of the capital, and together we'll all have an active role versus having a group of investors that control the deal and then another group that is completely passive. So I'll start by saying that.
Yep.
Then as far as numbers go, the numbers, we like to get into deals that we can be all in for 65% of what we're going to make the value. So like we just closed 96 units in January, and we got in for about a little less than 30 a door, so like $29,200 a door. And when we got the appraisal back, day one, like at closing, we were worth around $40K, and then with a little bit of work, we're actually going to be at a value of $50,500 per door. So $2.8 million purchase price, $4.85 million valuation, which will come once we fully stabilize the property under our ownership.
Awesome. So then is the game plan to refinance out of that?
100%. because we start we go about these deals a little differently. So we like to close them fast. We take almost a single family approach, but to the multifamily game. So a lot of single family investors will go in with hard money or private money, and they'll get into a deal and say it needs rehab, and they'll rehab it, and they'll rent it out, and then they'll refinance it.
Yeah.
We're doing a very similar strategy with multifamily. So we actually get into the deal. We have a good private lender.
Yep.
Bless you. We have a good private lender, and we're able to get sometimes 90% of the purchase price.
Yep.
So like on the 96 unit deal, we came in with $390,000 total equity, and then we got a $2.5 million loan. But with that being said,
Sorry.
the term you're good. The terms of the private money are not as good as traditional terms, but it's how we get the deal so good. So we get into the deal, we operate it for 3 to 6 months, and then we refi the money out.
Awesome. And then what are you doing in order to move up your cap rate or move up the price per door?
One, buying right. So we go in and we make sure we're buying it at well less than it's actually worth. So like I said, that one worth day one at closing, it was worth $40,000 a door. Now there are some things we want to make sure we can add value. So in the case of the 96 unit, it had very high utility costs, and we did a water study, and we found that we could save quite a bit of money just by replacing doing a few changes, some low flow shower heads and faucets and things, and then also implementing rubs more effectively. They had some rubs on the property, but they weren't utilizing it fully. So we're going to save quite a bit of money there. And then we also had some light renovations that we wanted to put into units. And one big thing is there were 6 down units, so that was affecting the value of the property as a whole. We have money to upgrade those units. Those will be at full market rent very quickly, and from there, it's just operating the property correctly.
Awesome. Is there anything like from my background of being from like the north that's unique to like multifamily down there? Do you guys still use boilers? Like, what is the use for heat? Because I whenever I was down in Huntsville, I found all kinds of things touring properties that I never seen before.
Okay, so we typically have individual systems for heat. I know Texas has a lot of boilers.
Yep.
I haven't run across one.
Okay, so you have like individual heaters, so then it's easy. Like, do you have the tenants pay their own hydro? Like, are you able to pass the buck to them on that?
Yes, in a lot of cases, certain submarkets maybe not, but in the case of the 96 unit, we're able to pass that on. Yes, and they were paying for electric. They just weren't. The RUB system wasn't really covering the water bill, because in Birmingham in particular, or in certain counties around Birmingham, the utility bill. The reason I like the way we're doing it, it's basically just a bigger BRRRR strategy, buy rehab, rent, refinance.
Yeah.
The reason I like that strategy is because money back to work quicker in a new deal. Those are just very high. The city went through struggles in 2008. And things collapsed, and the prices have not gone down. So with that in mind, we have to use these strategies to kind of lower that cost or pass the cost off to someone else.
Gotcha. All right, that makes a lot of sense. So for value adds, I know because I've talked to like some apartment syndicators before, and like a lot of them are like they'll go in and change countertops, they'll get rid of carpet, this is that sort of stuff too, or you don't even worry about that because you've already bought it, right?
So we will worry about that, but we don't. It's not the first priority. So the first for us, we'll do light turns at the beginning, which simply means, one, if it needs something majorly like appliances or things like that, we're gonna replace them. But if something that's easily turnable, where it's just a coat of paint and replacing the carpet or something like that, we'll go ahead and do that. Because we want to stabilize the property quickly. Now, the long-term goal is we do have decent units, but we don't want to turn them all at the beginning, because that's not where the value in this property is. It's in the cash flow, and the quicker we're out of the private loan, the higher the cash flow is. Then we'll come back over the course of a year or so and begin re-implementing further upgrades. So we do, have the vinyl plank flooring and things like that. We don't use granite or anything like that, but we're also in the C plus space, so it doesn't make sense.
No, is there something specific you look for, or just anything, any kind of problem?
So I would say it's closer to any type of problem, because my partners, they really are. Back in the day, they were doing these high vacancy properties. They actually picked up one that had no tenants, and it was condemned by the city. And they brought this thing up from nothing, and it turns out that is a ton of work, a ton of uncertainty, which makes sense, obviously. But so the last couple of deals, like the 75 unit we picked up in September, it was 94% occupied when we acquired it, and then the 96 we just acquired in January was 92% approximately when we picked it up. So the problems have been different problems. The 75 unit, it's an owner that was pretty well established. He kind of is like the biggest mom and pop possible, if that makes sense. So he has a lot of good product. He owns probably 3,000 units, and this one just didn't fit in with the rest of his portfolio. But it was in an area we were very familiar with, so we already had property in the general area. The economies of scale was good, and we had the experience to take over that sort of project. Yeah. So that one made sense from that standpoint, and he didn't negotiate very hard, so it ended up being a really good deal. And then the 96 unit was unique because it was actually on the market a few years ago, but it was part of a portfolio. And it was 4 properties, and the other 3 properties sold, but this one didn't sell to the same owner because at the time there was a title issue. I guess a lady had been claiming that a small corner of the property was hers when it wasn't, and so it clouded the title. And over the course of time, they got that title issue resolved. However, the buyer was gone, and this owner went through some struggles with managers. They were kind of bleeding cash flow simply because they didn't have the economies of scale anymore.
Right.
So we came in, we were able to solve that problem, essentially take the property off their hands. And they actually, unfortunately, lost money on that property, but I think with the whole portfolio, they were in the positive.
Gotcha. I'm going to change gears a bit. So when we were talking off the start, you were saying that you use JVs rather than doing like a syndication. I know the reason probably is just you have a lot less regulation that way. You're not dealing with the SEC and stuff, right?
Well, more so than that, it's the level of it is not as complicated. There are fewer people involved. So it's 4 people communicating with each other instead of trying to communicate with 40 or however many people it could be. So that's one reason we're able to we'll bring in 1 investor or 2 investors and we'll all work together. And there are a few reasons I like it. One, with the syndication, you have to get out. You have to get out in 5 years or 7 years because your investors expect to have their money back at that point.
Yes. Yep.
With the joint venture, because we're all on the operating agreement, we all have to agree on the refis and on the sale. We're all making decisions together. So if it makes more sense to hold the property, which a lot of the ones we pick up we're expecting to hold for a longer term than 5 or 7 years, we're able to agree to that at the beginning. They're going to get their money back pretty quickly anyway because we bought right, but then we can cash flow the property for a longer period of time. We can sell it when it makes sense in the market instead of being forced to sell in 5 years or whenever our term is. So we like long-term debt, 10-year plus terms, and yeah.
No, I like that too. It helps recession-proof yourself too, right? So if there actually is a correction, which everyone says is going to happen, but they've been saying that forever. But anyway, just having longer term financing, you don't have to try and refinance whenever you don't need it, right? Or like whenever you're in a pinch, right? It's always hard to get money when you need it. So anyway, so you have say sort of like 4 people kind of thing. How do you structure that? Are they just equally split 25, 25, 25, or how do you structure your thing?
So we're going to negotiate that every deal. Yeah. Sometimes someone's bringing more to the table than others. Sometimes, like with the private money, for instance, a lot of times it is technically a recourse loan. So one of us is going to take the personal responsibility for that and make sure that the person we bring in doesn't have any of that, and there's no risk for them in that sense. Yeah. So obviously we're taking more risk from that standpoint, and sometimes
however it works,
the equity is split different. Yeah, so that's always that's different deal to deal. Like I don't have the same ownership in just about any of the properties I own. It's different every time. I would say this. I'm just going to kind of tell you what my strategy is, and maybe that'll help somebody.
Yeah.
So when it comes to these joint venture deals, I do invest my own money. So and each member of my crew invests their own money as well, because we want to show whoever we're bringing in that we believe in the deal too, for one. But 2, they're good deals and we're making the money grow. So with that being said, I'll put maybe $100,000 or whatever I need to put into a particular deal into the deal, and I know it's going to be there for about 6 months. And I also know that hopefully at the end of 6 months I'll have another deal to put that same $100,000 in. But here's the thing. I'm going to be getting a percentage off that money. So say I'm making 8%. Yeah. But then I do it again 6 months later. And after a year, I'm making 8% twice on that same money.
Yeah,
so I'm making 16%.
Yeah,
so I'm trying to stack. I'm just trying to stack that money over and over again. And but the cool thing is we're making more than just the cash flow. We're making some money in the equity. We're making some money on the refi because we'll refi a little bit more than we put in. We don't like to get crazy. We like to keep LTVs below 75, but we can pay ourselves that way too. So I might come out with 120 grand and have that 8% cash flow. So I have a little bit more to invest the next time, right? And it just builds. So that's my strategy. And the thing about a syndication that I don't like is that your money's there for 5 years usually or more.
Yep.
So I can't stack that money. I can stack the cash flow I got from it and reinvest that, but I can only reinvest the cash flow until that big chunk comes at the end. So the biggest success I've had is people that one are experienced in either some sort of real estate investment or business. So sometimes they've been investing in single family and they're ready to take the jump. They just didn't necessarily know how, or they are very successful in business and now they're looking for a place to invest that money. The reason those work best is because they actually give us a benefit from the standpoint as they know what they're doing and they have an idea why this would work. They also, the thing about the people that have been in real estate but haven't necessarily gotten to the multifamily is they get instant credibility. When you get into a deal, a joint venture partnership on a 90 unit, that's on your record, so to speak. Brokers start to take you seriously. And then the law of the second deal, the second deal comes a lot quicker simply because people you get that credibility. Yep. So that's the reason why those have worked best. And it's also been very cool because they're coming out to the property and they're seeing the improvements and they're working with us because they have to be active to a degree because it's a joint venture.
Yep.
And that's super awesome. So we're educating them, but they're also educating us because they have different perspectives from whatever business they were in before, or even from their single family business. Sometimes it's as simple as, oh, we could get better insurance on this because I know a guy. Great, bring him in. Let's do this. So it.
Yeah. No, it makes a lot of sense. Yeah.
Yeah.
Because like I said, I've talked to a lot of syndicators, and off the start, you're always like, "What's your origin story? How did you get here?" And they are always bringing in a sponsor off the start to get credibility.
Yes.
In order to be able to get the financing. Yeah.
Yes, I mean, same idea, same exact idea. You got to build a team. You got to have a team to leverage, and I'm grateful for my team because they're awesome.
Awesome. If somebody wanted to get a hold of you, what's the best way to do so?
Facebook is a great way, facebook.com/relentlesscaleb. Instagram as well. It's at relentlessinvestor. And then you're welcome to email me at relentlessinvest@gmail.com. Sorry that none of those match up, but definitely reach out. I'm happy to talk.
Awesome. Thanks so much for your time. Really appreciate it.
Hey, I appreciate it, Glenn. Thank you so much for having me on the show.